Hey everyone, and welcome to another video. Today, you'll learn some basic accounting concepts that are necessary for understanding financial transactions. So, let's get started. Let's start with the separate entity concept. It states that the financial transactions of the business are recorded separately from the personal transactions of its owners or stakeholders. Separate entity concept helps in clear financial reporting and prevents confusion between personal and business finances. Imagine a business owner buys a laptop for personal use and another for business purposes. According to the separate entity concept, only the expense related to the business laptop would be recorded in the company's financial statement. Another expense would be recorded in your personal account. That's how the separate entity concept works. Second, the most important concept of accounting is the going concern concept. According to this concept, a business entity will continue to operate its operation for a long period in future and shouldn't shut its operations for any reason. For instance, if the head of the company resigns or dies, the company will continue running its operations in the coming years. Third basic principle is the double entry concept, which states that any transaction that occurs has two aspects, one that goes out and the second that comes in. This concept doesn't mean you made two entries in the same account, but in two different accounts. Through this concept, you can get insights into how your business is performing and help you maintain a good transaction record by reducing any bookkeeping errors. For instance, if a company buys any product for £500, its cash account decreases, that is, credit £500, and the asset account increases, that is, debit £500. This concept keeps accounts balanced and accurate. Last, the key concept in accounting is the matching concept, which states that the expenses used to generate revenue in a specific period should be recognized in the same period. Let's say a bakery bakes a delicious bread in March, but they won't sell it all until April. Under the matching concept, the cost of the flour, yeast, and other ingredients used in March would be recorded as an expense in March, although the bread isn't sold yet. This gives a clear picture of the bakery's profitability in March. By ensuring expenses are matched to their corresponding revenue, the matching concept gives a clear picture of a company's financial performance. Investors and creditors make informed decisions based on accurate financial statements using this concept. Not only that, you can compare a company's financial performance across different periods by seeing how expenses relate to revenue over time. Now, you're familiar with the basic concepts of accounting. Stay tuned to learn more about the double entry system of bookkeeping.